Joining us now on the markets is Noah Blackstein, Senior Portfolio Manager at Dynamic Funds. And what usually happens, generals advance, soldiers catch up. The S&P goes to new highs before the end of the year, Noah?
Probably, and there should be a lot of catch-up coming in the Russell small caps and mid caps as well, which we've seen begin to move higher and have broader participation right now, which is very good to see. You know, it's been for a lot of the year, it was a very Mag 7 focused type of market. Participation is broadening out. You know, we've had a nearly 100 basis point decline in the 10-year yield since the end of October. So it's good to see this broadening out. And that bodes well for 2024 in terms of returns. Certainly not as concentrated as before, but should be broader based returns for sure for 2024.
Something that you always have to deal with, investors always have to deal with, is that there's what dictates a price is the multiple that you put on earnings. So, and a lot of times they're headed in different directions, or at least there's cross currents. So what brings interest rates down, whether it's lower inflation or slowing growth, could impact earnings and vice versa. So net, what does this mean? You expect multiples to expand enough to make up for any slowdown we see that the Fed's already orchestrated?
Well, I think, one, we certainly are going to have, the economy has certainly slowed for sure. There's not a lot of precedents to go with, right? Because post World War II, where we saw a similar decline in inflation very, very quick, we had a Federal Reserve and a Treasury Department that had agreed to keep rates low during the war and after that. So the only sort of period we can go back to is kind of the mid-90s, where we had that Fed hiking cycle from 94, 95, from 325 to 6. And then we had that mid-cycle rate cut of at least 75 basis points during the 95, 96 period. That's sort of where we're going. So the question is, has the economy at a reasonable level of growth and rates can come down a bit to keep you're still going to have a positive real rate. So I think earnings, of course, always matter, and next year will matter. But we've had stabilization in the economy, and we'll get some relief on interest rates. So, I think investors can be a lot more stock specific, focusing on the best revenue and earnings stories in 2024, and things might be a little less groupy or clustered, where it's just certain sectors are moving. So I think you can be much more stock specific, especially as this market broadens out with small caps and mid caps now beginning to participate.
Well, Noah, if inflation does come down a little bit or stays in this disinflationary mode, but the jobs numbers, if that stays strong and if the economy stays strong, would you assume that the Fed would cut? Why would the Fed cut? If just inflation comes down, does the Fed decide to follow through on 3 rate cuts, or do we have to have a slowing economy?
Well, I think what the Federal Reserve sort of said is the use of perhaps of a Taylor rule. And so, you have 6-month annualized PCE now down at 1.9%, which would be below their target, and Fed funds at 5.25. So if inflation continues to fall, they continue to do QT, and they're leaving Fed funds where they are, then de facto they remain tightening. So moving nominal yields down and keeping real rates the same or a little bit lower would actually still be them in a neutral stance or slight tightening bias. But if this 6-month annualized PCE of 1.9 stays there, and you have 5.25 on Fed funds, and you're looking at close to over 300 basis points of real rates, that's excessively tight monetary policy. So I don't want to get too confused between nominal and real rates. I think real rates will remain positive. That the era of ultra low real rates or negative real rates is past us. But nominal rates at this level, given where inflation is, have room to come down. That doesn't mean the Fed. It doesn't mean that rates are going to go back to 1 or 1.5, maybe somewhere in the 3 to 4% range. But it's those real yields that will stay positive, but nominal yields that will come down. That seems to be very prudent monetary policy.